This video will help you understand how asset location works so you can decide if it's right for your overall portfolio. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Asset location refers to the strategy of locating tax inefficient investments within tax deferred environments, like retirement accounts. Likewise, it involves locating tax efficient vehicles, if you have to, within non-tax efficient investment accounts, like brokerage accounts, for example. In the plain vanilla context of wealth management, this would look like owning all of your bonds, which produce interest, within an IRA, and owning all of your stocks, which are usually thought of to generate capital gains, inside of your taxable brokerage account, for example. Now, there's far more nuance and definitely some pros and cons to be aware of, and so in today's video, we'll break down what those are. So let's jump in. So to quickly differentiate between asset location and a very similar term, asset allocation, asset allocation refers to the overall composition of someone's investment portfolio. For a very simple example, let's think of an investment portfolio that's 80% stocks and 20% bonds. For one reason or another, perhaps you and your advisor or you by yourself decided that this is the right portfolio for you. This is considered your asset allocation. And it's far more important than any other cool whiz-bang tax efficient strategy you can do. And it's probably going to be one of the biggest drivers behind your investment success. The point here is to maintain your asset allocation pretty much regardless of market conditions, but it's different than asset location. Another cool whiz-bang strategy out there is tax loss harvesting, and I've got a video breaking down how this functions. But ultimately, tax loss harvesting refers to within the confines of a non-retirement investment account, like a brokerage account or taxable account, selling certain securities or positions that are at a down location relative to where they started, so that you purposely generate a capital loss. Now, if all of your money is inside retirement accounts, you can't do this strategy, and that's fine because you're not paying any taxes anyways. But if you have money inside of a taxable environment and you purposely capture that loss, you can use that loss to offset future gains, either in future years or later in that tax year, whatever. But again, you wouldn't want to violate your asset allocation by doing tax loss harvesting. As long as you stay within the confines of your asset allocated portfolio, you're in the clear. And you absolutely could generate some after-tax returns that are higher than if you didn't do this strategy. Finally, the purpose of this video, asset location, refers to owning tax inefficient investments inside of tax efficient accounts and vice versa. If you go back to our very simple example of an 80-20 portfolio, 80% stocks, 20% bonds, that would look like in a perfect world, at least owning all 20% of your bonds within an IRA, for example, and then owning as much else as possible inside that IRA as well. And then if you have to have money inside of a taxable account, having all of that just be the stocks. Generally, this kind of strategy is only applicable to the higher echelons of income and wealth. And at those levels, usually funding a retirement account will not satisfy all of the savings needs that a particular family has. And so by default, you'll end up with both taxable and tax deferred money. Money inside of a retirement account and money not inside of a retirement account. In addition, if you work at one of the major technology companies and your compensation is heavily in stock, you'll end up by default having a taxable investment account. They call it a TOD account, and it's where all of your stock vests land or your employee stock purchase plan or options, whatever. In the simplest cases, it pertains to taxes on particular assets. Stocks are thought of to generate capital gains, and bonds are thought of to generate interest income. Capital gains is generally taxed on the federal level, somewhere in the ballpark of 0 to 20%, and interest income is taxed generally between 0 and 37% on the federal level. Now, there's state income taxes to be aware of, net investment income tax, etc. But for the purpose of this video, to keep it simple, usually, dollar for dollar, people will prefer generating $10,000 of long-term capital gains rather than $10,000 of interest income, because the interest income of 10 grand will have a higher tax bill associated with it. Now, I'm clarifying that that tax arbitrage or difference is only related to long-term capital gains versus interest income. Short-term capital gains, on the other hand, which we'll dive into later, is taxed in a very similar way as interest income. But ultimately, this is where the strategy comes in handy. If you could own all of your heavily taxable investments inside of an account that pays no taxes, namely an IRA or a Roth IRA, well then you're going to be a far more tax efficient investor. Now, of course, if all of your money is inside of retirement accounts, then you have nothing to worry about, and this strategy doesn't make any sense for you because you're not paying any dollars on capital gains or interest income generated by your portfolio anyways. Your tax bill will be when you actually decide to take money out of the portfolio, or in the case of a Roth IRA, you've already paid all the taxes you're ever going to pay until maybe Congress changes something. But I sure hope that doesn't happen. Let's walk through an example, and for this, we'll jump to the whiteboard. So for an example, let's say Bob has
$1 million of assets to allocate to various investment accounts. Of his $1 million, him and his advisor agree that 80% of it should be in stocks and 20% should be in bonds. The way this would look like from an asset location standpoint is he'd have $200,000 in an IRA, and all of that would be in bonds, and he'd have 800 grand of this 80/20 in stocks, and that would be in a taxable environment. Okay? So here are his stocks, and these are bonds. On paper, this satisfies his 80/20 portfolio. He's got all the bonds held within a retirement account, and that helps him avoid paying interest income, which is less favorable than long-term capital gains taxes. In reality, however, there's a few challenges that come into play. Number one, I don't know anybody that would perfectly have it able to be asset allocated and then asset located just like this. Normally, people are going to have either a smaller IRA or a larger taxable account or whatever, and you won't actually be able to have all of your bonds inside of an IRA and all of your stocks outside the IRA. Also, what do we know fundamentally about markets is all investing takes on risk, which means that your holdings go up and down, right, as the market fluctuates. So in this example, what if his $200,000 IRA that was all in bonds, a couple years from now turns into a $100,000 IRA? Again, it'd all be in bonds as far as the fair market value is concerned. And now he's got a $100,000 IRA, and let's just say his stocks did really well, and he went from 800 grand in stocks to 900 grand in stocks. He's still got a million. He still needs to be in an 80/20 portfolio, but now he's in a 90/10 portfolio. This is not in alignment with what him and his advisor agree he should be in, so he's going to need to do what's called a rebalance and find a way to strategically get back here. That generally means selling stocks and buying bonds. But in reality, you can't just sell 100 grand of stocks and move all that into your IRA. So eventually, he'll have a portfolio that's, maybe 900 grand in a taxable environment that has, 100 grand in bonds and 800 grand in stocks, and an IRA that's 100 grand in bonds. Right? So now he's still going to have some bond interest income kickoff, which is tax inefficient, and he'll try to maintain the long-term capital gains only out of the stock portion of his portfolio. And over time, you can see how it gets more challenging to employ asset location in a perfect world. The best he can hope for is just owning all of his bonds inside of a retirement account until he no longer can.
So, a few other challenges present themselves when it pertains to actually executing asset location in the real world. Number one, bonds are thought of to generate interest income, but they can actually also generate capital gains. And stocks, while thought of as generating capital gains, can also generate income. If I buy a bond, or more likely I buy a bond fund, and I purchase it for this, but then in a year or so I sell it for this, well, that's a capital gain. And so the bond allocation of my portfolio could actually generate capital gains. It throws a wrench in things on paper. In reality, if all your bonds are owned inside of a retirement account, well, then it doesn't really matter because you're not paying a dime in taxes anyways. More likely what the problem would be is if you actually own stocks outside of your retirement accounts because you're executing asset location. Some stocks can actually generate income, and that's in the form of dividends. That's super common on social media and Reddit, for example, to have a dividend generating investment portfolio. But qualified dividends, which are the most common type of dividends, are taxed very similarly to interest income, 0 to 37%. So it's something to be mindful of depending on which particular stocks you're purchasing outside of your retirement accounts to try to shroud it from overall paying too much in taxes. You might still end up paying a couple bucks in income taxes, basically, due to the generation of dividends. Additionally, as we touched on before, if inside of the stock portion of your overall wealth, you're doing any sort of less than 1 year trading, well, then you're going to generate either short-term capital losses or, in a better world, short-term capital gains. The problem is with short-term capital gains, those are taxed as if it was interest income, and you're going to pay whatever your highest federal marginal tax bracket is on those capital gains. So then 10 grand of interest versus 10 grand of short-term capital gains makes no difference because they're taxed at the same rate. So probably something to avoid if you're going to employ asset location successfully. Lastly, individual stocks, individual bonds, mutual funds, and index funds all have different tax ramifications and things to be aware of. Some you can control more than others. That's not even to mention things like government bonds or municipal bonds, which might avoid federal taxation but might still have state and local taxes with them as well. As we wrap up, I would say asset location sounds super sexy on paper and if there's lots of zeros involved, could absolutely add to some after-tax net return in excess of situations where the strategy wasn't employed. Specifically for those at the higher echelons of wealth and income, this could make a lot of sense. However, for most people, with all of the moving pieces involved, this is probably going to end up being more trouble than it's worth and result in an exercise in futility. And all the studies would seem to show that people are much better off focusing on the fundamentals like staying asset allocated in the right portfolio over time, not trying to time the market, and paying down debt and saving enough for retirement. So if you've done all that and the math makes sense now to either do it yourself or hire someone for an hourly rate, for example, to employ tax loss harvesting, then more power to you. But generally, I don't find this is the case. So calls to action would look like analyzing your current situation to see if you should employ tax loss harvesting. In general, I would say this is probably not going to apply to you. And if it does apply to you, most likely you have a team that should be handling this for you. And maybe it's something to bring up at your next review. If you have further questions, drop them in the comments below or get in touch on the website. We'll get you squared away. Have an awesome rest of the day. Talk to you later. Bye.